Okay, so Robert asks, I've been paper trading a bullish income strategy using a covered combination. That's similar to what Terry asked about earlier. Covered combination is usually buying the stock, selling an at or out of the money covered call, and then selling it out of the money put. Robert wants to know, what do you think about going long-term in the money put to this structure for protection? The objective would be 1 to 2% weekly income. I think it's dangerous, Robert, but it's what I do, but not what I do. For the beginning 15 to 20 minutes of our conversation, we were talking about the married put position. Let's just go back to the eBay position on the search. And I had mentioned that I don't, with the proper structure we're talking about, which gives a single-digit risk to begin with, Robert, I'm buying a put that is increasing my cost basis, okay, up to $39.57. And the stock right now is at $36.20. So here's the issue. Even though weeklies are available on my Yandex position that we just looked at and on this brand new eBay position, I didn't open this, but the eBay position we're seeing right here, even though weeklies are available, do I have any premium at the 38 call where my strike is? No. Do I have premium here at the 37 strike? Yes. 24 cents. But remember what I said. When I do this, it doesn't matter to me. I said monthly, Robert. Let me rephrase that. I said monthly. I want to look for a third to a half. The call I sell, I want to reduce this by a third or a half. Going weekly, I might say a fifth is okay. But again, you don't want to sell the weekly call in this structure just because weeklies are available. It should match the rest of the criteria that we would use. Otherwise, you're going to get yourself into trouble. How are you going to get yourself into trouble? Let's backtrack. Remember, if I choose to open a put structure, married put structure in this case, I'm targeting the stock that I feel has the potential to move up 3 to 6% in the first 20 to 40 days, and I'm right about 75% of the time. Now, what is that here? Let's take 5% again. That's going to be about $1.80, so that's going to put me right at $38 per share. Okay. Now, yes, I'm selling something that's 7 days out, but I mean any time in the next 20 to 40 days. Could be early, could be just somewhere in the next 40 days, let's say. Okay. So I sell a 37 call for 25 cents. Did you lower the risk? No, you increased it. Did you get 1% premium? Well, you've got a max return if the stock's trading right at 37 of 1% of your 1 to 2%. I know this is just one example, Robert, but this is the common thing that you see when you're doing this. But remember, my target for growth is here. And I'm selling the call here. Does it do me any good to collect 25 cents right now if my target is hit and I have to pay $1 to buy it back, so I actually increase this risk by 75 cents? And you say, now wait a minute, you started off with 4% and you got 25 cents. How can the risk go up? It went up to the upside in the direction I thought the stock was going to go. Okay? So you see where I'm headed. What happened is when you buy the in-the-money put, what we feel properly, the in-the-money put to take advantage of the at-the-money bell curve, the proper position sizing, the 3 core principles of radioactive trading initially, yes, you increase the cost basis, but you're setting yourself in the structure that you want. The minute you sell this call, just because the weekly is available, and you sold the premium for too low, now you're trading against yourself. This 1% I said you generated only occurs if the stock's trading right at 37. If it's trading at 36.20, okay, you keep your 25 cents, that call expires worthless. Trading at 36.80, okay, that call expires, you've lowered your risk by 25 cents. Not near the fifth that I'd want for doing a weeklies from the original $1.58 risk. If it's up at 37.50, I got to pay 50 cents to buy it back. So now I'm adding to that risk to begin with. Now this upside risk is gone. Once that call is gone, it's going back to the 158, but I had to pay 50 cents in. So now I'm at a risk of 208. I'm going in the wrong direction because I forced a sale too soon. And I forced it at too low of a premium related to the position and related to the cost basis. I'd want to wait for the stock to move up And then, if the weekly option that's 7 or 14 days out in time matches the guidelines where I need to be selling a call above the put strike price so I don't see this. Oh, sorry, folks, get out of that. So I don't see this risk to the upside. I don't put myself in a double loss syndrome, which I don't want at all. I want that upside to be open as much as possible, especially over the last 4 months or so. But in any case, that's what we're looking to do. And you don't want to do it too soon just because weeklies are available, because you handcuff yourself and you can end up adding to the risk and piling on losses by continually trying to adjust and roll this position. It's better to wait and then wait for a premium that looks good enough to reduce your risk where you stand right now by at least, a fifth or so, maybe a sixth. But you saw that that wasn't even close. Okay, so fundamentally your idea is sound. By going in the money and further out in time, you're going to set yourself in the structure to have the best risk control. That's what we've been doing for 12 years. That's what Kurt's been doing for, almost since 2002. Okay, we've got the controlled risk. But the minute you say, well, what's good for the goose is good for the gander, so if I'm able to sell weekly premium, I might as well do that. If you do it wrong, you set yourself up for the wrong structure. You can get hurt to the upside in the direction you thought the stock was going to go. And that's not the right approach. That's not what you want to do. And that is why, of course, I'm sorry, as I mentioned before, when we were talking about it, that's what's discussed in that blueprint, is not only the proper structure of how to set up the position to keep 4.6% and follow the 3 core principles, but the full use of when and how to use the 12 different income methods to adjust it. Can you use weekly options? Yes, if it matches the rules to keep you out of trouble. Don't force the weekly sale just because the weekly is there. Okay? That's what we were talking about there in relation to that. And why are there 12 income methods? Well, some of them work best if the stock moves up in price from when you first get in. Some work best if it moves down in price, and some are best used if the stock stagnates. Right? For the different things that can happen, there's different income methods, Robert, that can be used. Okay, let me just scroll down here for a minute. Okay, Sam was talking about the Casper IPO dip the second day, so he had gotten into it originally, but he had traded out, I believe. And there was another comment from Sam regarding the DT trade that got stopped out. Okay, I'm going to bounce to David real quick because these are a couple quick questions here from David. David says, do you know of a place to get a list of the tickers for all weekly options available? For instance, on cboe.com, they only list their own. Yeah, you can pretty much get all of them on PowerOptions, but you just got to do something a little bit tricky. And David had a follow-up when we were talking about the eBay. I'll have to look into this. Thank you, David. I didn't know that. He said, David said there's a discussion on Bloomberg about a foreign company taking a run at eBay with a buyout. That'd be pretty interesting there. Okay, so David, your question. Let me show you. Oh, it was DT was the stock that Sam was talking about. Okay, so what I'm going to do when someone asks me a sort of question is do you have a list of stocks that are X? Do you have a list of stocks that have earnings in the next 10 days? Do you have a list of stocks that offer only weeklies? Well, there's two things. I want to go into a single option strategy. I can use covered calls, but I'm going to change to long calls, David, for this example. Now let me go into let me go into the other strategies tab. There we go. Let me just take out, why not? Let's take out covered call for now, and I'll put long call in. Let me save that configuration, folks. Okay. Now, there's two things, David, that can help you with this, depending on how you want to do the weeklies. Okay, if you're actually looking for a search, if you're looking to search for stocks, search for positions that match your criteria in a given strategy, David, on weekly options, there's two ways to do it very easily. Number one, whatever strategy you're using, put in your criteria into PowerOptions, select all expirations, and just put your expiration date to 0 to 8 days. Now you know only those stocks are the ones that offer weekly options because they're expiring in 8 days. You could just go to the list field in PowerOptions, okay, and scroll down here to the available company lists and more. I'm sorry, I got to open that up a little bit. It's the last choice. Yep, stocks offering weekly options. This is updated every week. I think this list might be updated twice a week, but really the new options, as you know, typically only come out on Thursday. So if there's anything new in there on Thursday, we'd be able to see it. So we have a list where you can screen just against stocks offering weekly options. If you just want a printable list, that doesn't give you a printable list. That allows you to scan against a printable list, David. Now let's do this. Let's clear filters. Next week is a weekly expiration. It's not the standard. The standard's on February 21st, okay? So where every optionable stock index or ETF has that. So what am I going to do? I'm going to say what positions are out there that expire between 5 and 8 days from today. I'm just trying to isolate it. I'm also trying to remove SPY or SPX showing up with those Monday, Wednesday, and other series. The Fridays will still show up, but I'm going to try to push out Wednesday and just keep Friday. And I'm going to tell the system I only want to see, because I'm doing a long call screen here, David, so I'm telling it to just show me calls that are greater than one strike but less than one strike out of the money. What is that doing for me? That's showing me only the out-of-the-money strike for any stock that has an expiration in the next 5 to 8 days, i.e., I will see one call for every security that has an option expiring next Friday. It's a little trick, a simple little trick. That looks about right. 575 total results. I think that's right. There's 575 securities right now that offer, as securities, I mean ETFs, inverse ETFs, indexes, and more. Total of 575 securities. Now, if I just wanted the stocks, David, let me go back to the lists. And I want to remove a full list of indexes and ETFs. You had said stocks. I don't know if you meant securities, but you said stocks. So let me get rid of those inverse ETFs, regular ETFs, and indexes. Let's submit that, see if we can narrow it down. Should drop down to 430. That seems high, but I think it's 430. Sorry, folks, needed a drink there. 481. I was wrong. So I don't think there's any duplicates in here. I think I'm looking at everything that's 7 days out that is a weekly, and I've got 481 results. I can go through the pages. Now, you asked for a list. From this point, what I could do is add, remove columns to just take everything out here and just put stock, stock price, and maybe some other information. But I can click on the printer-friendly version. This might not print out all 481 securities. It has a break on it in the printer-friendly version. But what do you see here in a printer-friendly version? Unlike that search table where it has the images and the padding in it, this is just a straightforward, you can almost copy and paste directly into Excel. Okay? So again, you could adjust the columns using that add remove column feature to just see the company name, stock symbol, last price, and maybe the option information if you wanted to. You could probably remove all of that, just have those 3 columns. Submit that search, go to the printer-friendly version, and then copy and paste your columns, print it out, print this out, do whatever you wanted to them. So it's a little trick there, you can find it. But again, if this is limited, it might be limited, I'm sorry, so it's 481 results. I think it goes up to 600. I'm not positive on that. It's 500 or 600. But what you could do is say change the sort and sort it by stock price, or better yet, sort it by company name. Okay, highest to lowest or lowest to highest. Why? Because now when you go to the printer-friendly results, if you see it cut off at S, then you know that you can change some of the criteria there to sort of narrow it down to just that as well. I've got it reversed here. So I've got some Zyngas, Zscaler, and more. And let me reverse it. So I'm sorry, David. Give me 1 second. We saw Zynga and Zscaler. Zoom video. Oh, that was a good one the other day. Zotis. I had a customer, a coaching session on Monday with a customer asking me about managing Zoom. Okay, so we start with 3D. Let me just go to the printer-friendly versions again, David, very quickly. Go all the way down to the bottom. Sorry, folks. They're all there. Zing to the bottom, right? Those were the ones that were at the top in alphabetical order. Now they're reversed. So all 481 are there. Zynga, Zscaler, Zoom, Zotus. So everything from A to Z is there. It doesn't look like there's any duplicates because I used that one-to-one strike difference. Okay, so there you go. There's your list of stocks only offering weekly options because I took the index and ETFs out. You could add the indexes and ETFs back in, and we saw 575 right now, David. That's a good check. I was out of date. Last time we did that was probably, I think, April or May of last year. I swear it was at 520 and then 430 for the securities. The total was 530, 540, and I thought the stocks were only at 420, 430 or so. Now we see that we're at 481, 575 total. Fernando, back to you. It's Sam just says on the straddle you can sell premium, but you need to be active. Yeah, sometimes even day trade. That's always a trouble that we've had there as well. Okay. All right. Okay, so okay, let's see here. Okay, so let me go back to the beginning. I don't know if I addressed this yet. This was from Marvin. This was earlier, but the question is subtly different. So when we were talking about earlier stuff with Terry, my apologies. Marvin says, I know you're talking straddle, but my question is about how often is it wise to keep rolling up a put that is profitable and you're bulletproof? I never roll it if I can't be assured of at least 50% of the strike. Yeah. Okay, so that's something different. When and where did I address this? This was done. Hold on one second, everyone. Marvin, I can't remember which presentation this was in, but I could have sworn we just covered this in one of the recent Blueprint Owners Only webinars we did in the past few weeks. We did about 2 or 3 of them. We're supposed to do one this week. It didn't happen due to a technical issue. I wanted to get some stuff done today, but that didn't happen either. Let's see here. Okay. Oh, okay. It must have been here. I don't think it was a look into income method number 1, but it's. I'll find that for you to review it. But if you log on to RadioActive Trading, Marvin, as a Blueprint owner, in the case of the married puts, you'll be able to see the Blueprint Owners Only webinar. I think, I'll check this out for you later, but I think I started off the Owners Only Q&A session with that 15 to 20 minute discussion about when to stop doing it. And I included in that 2 examples, or the main discussion is, Ernie kind of feels that, look, once you've bulletproofed it, you may not want to continue using income method number 4. And then I showed the example of when I used it on Silver Wheaton back in 2008, 2007, I can't remember, where I had the position bulletproof to about 10% and the stock kept running up and earnings were coming up, and I figured why not? I used income method number 4 one last time to get a 28% bulletproof status. Why not? I was at a liquidation value at that point of about 35. Why not roll the put up one more time even though I'm bulletproof to make sure that I'm still going to make about 30%. It was 28%, I believe, on the position. That was my bulletproof status, and leave the upside open through earnings. And it did, and the stock jumped again, and that's the position we got out with a 58.9% return. The worst case scenario is I could have made 30%. Did I take an additional 5 or 6% off that potential top where it could have been a 63 or 64% gain had I not done it? Yes, but if the stock fell the same direction downwards, I would have only had a gain of 10% instead of 28%. So where's the trade-off, right? It comes down to the situation in that case. Why would you be bulletproofing again? Why would you be increasing the bulletproof status? Are you fearing a market correction? Are you fearing something going forward? And then the trade-off of how much profit are you taking off and what's the payout? Okay, that's what it kind of works. But I think the first several minutes of this Blueprint Owners Only webinar from January, I think I took that topic on because we had 3 or 4 people ask that question that were 2 new Blueprint owners and 2 old Blueprint owners that started coming back when we were hosting the webinars from December to January. And we addressed that there. So that's the best place I can show you. The short answer is Maybe after you've bulletproofed it, why roll it up anymore? The long answer is, well, it depends on what your goals are, what your expectations are, and what the trade-off is as well. Okay. So that's the best way, Marvin, I can answer that question.